All right, so let's get ready to do the PLTR. They have earnings. It's been a hot stock last year. I gave the $100 price target, and I think it was trading at probably 15, somewhere in there. It sounded a little crazy, but here we are, you know, consolidating sideways action around the $80 mark. When I look at this chart, the first thing that I see is that I want to see when did we make the high? The high came in at around December, about the same time that the market made the high, and then it's basically consolidated. It came into a demand zone here, right there. It worked very well for the push up, and it created new inside and up formation. So this right here is going to be our bottom, if you will, if we were to pull back into earnings. Remember, we are using supply and demand into earnings regardless of the earnings catalyst. What we know is that the earnings catalyst can push price to that demand zone and then buyers can show up. There's a lot of different ways to trade the idea of earnings. One is you can come over here and we could get ready. Let's just, say that the market has closed. We understand where buyers are looking to get in. I would come over here to my active trader. I could make sure that the TIF is set to, extended hours, meaning after the bell, right? And then earnings hits, and I'm sitting here on the bid or the buy, and I'm waiting for prices to get to my levels, and then I execute the trade. All right, that's a really easy way. But I love using options. And the reason why I like options is because you don't necessarily, sure, you could use the active trader, get into equity, and still take a stop. But with earnings, I love the idea of a debit spread to the downside and the upside. And basically, when you price in both of those, you want to make sure that if one of them were to hit, that you're going to make enough money to pay for both sides plus some. All right, that's like the perfect scenario, and a lot of times it does happen, but every once in a while the market actually opens up flat. So basically what's going to happen is I'm going to find you a level on this chart, and then because we're at highs, I'm going to find you a Fibonacci extension level. I'm going to create some zones, and I'm going to tell you, hey, we are going to structure some debit spreads at or around this level down here, and what we would expect to do is get paid if price were to break all the way through this, or if we were to open up here. Okay, if Palantir were to gap up into the level that I give you, then we're going to get paid up here. Again, I'm going to give you a hypothetical. Let's say this costs $2 to buy. Let's say that this costs $2 to buy. My total is $4. And let's say on either one of these, if we were to hit them, we would get paid $500. Okay. That would take care of the overall cost and we would be profitable. Okay. If for some reason, let's say that Palantir were to drop all the way down below here. We collect the full $500. What I like to do is buy back the short side of the debit spread here every once in a while. This is not a guarantee. Every once in a while, what will happen is you'll get paid here, and then all of a sudden the market moves up, and then you get paid on these as well. That's like the perfect scenario. The worst scenario is when the market opens and even after they report, price just stays flat. And so what happens is you pay up the premium for both of these. All right. These are debit spreads, not credit spreads. It's not an iron condor where you're taking in credit. So the worst thing that happens is we go sideways. Both sides of the premium absolutely decays, and you're pretty close to an all out $400 loss. Okay. Now, in this event, what you can also do, especially with a name like PLTR that's reporting today, it's only Monday. So, what you can do is if the premium dies on both sides, what you're going to do is buy back the short side of both sides. And then what you're looking for is Tuesday into Friday that it decides to move. And so, what becomes a very cheap, I guess, call or cheap put ends up actually paying you. And there is a possibility that you can recover that 400 and sometimes even more. Okay. So let's get into finding out what we can use far as levels are concerned today. All right. So we've already found the demand zone to the downside. A couple things that I'm looking at is that the 9 EMA is close to the zone. All right. So the 9 EMA at the moment is at around 76, and this is down to 72. So for me, what I would probably look at is 77 by about, I don't know, 70, 70? 77, maybe 75 by 70. So we're just going to put that number out here for right now. So 75 to 70 to the downside. All right. And that puts us pretty close to this level here, the 9 EMA, and also the zone. So we're kind of capturing all of that, if you will. Now, in order for me to get a good Fibonacci extension level, there's a lot of things I take into consideration. One is just using the tool. We click on the wheel here on Thinkorswim, and we're going to check this right here where it says Fibonacci extensions. I'm going to look at where the rally started, and I'm going to place my coefficients. Coefficients is just a fancy word of the numbers that are outlined on the measuring stick that we're using. So we're going to double click there, and that's going to bring me up to the 23.6. And I like to use the 23 by the 50. We're just going to come down just a little bit lower underneath the 23, and then I'm going to select the 50, and that's going to give me the Fibonacci extension box. My next thing that I use is just a little bit of detail. And I think to myself, okay, one real quick, the reason why we're using Fibonacci extensions is there is no structure to the left to identify a supply. This is an all-time high, and therefore I have to use Fibonacci extensions. This is the only time that Trendy uses Fibonacci extensions. That is my rule. When I see people using Fibonacci extensions when you have structure, it makes no sense to me because we use supply and demand identified by structure. Okay. So this is where I think prices could go. All right. So does it make sense though? Right. In order for me to get to 90, I'm looking at almost a 10% move. If we were to look at just the regular ATR, it says it takes a month to get about what I want to see into earnings. Now, this is where a little gut and a little bit of time in the seat takes, I guess, control of how I feel about going into earnings. One, it's a very, very strong stock. It's moved a lot and it has a lot of momentum. If they even say anything remotely bullish, this thing can fire up and move really, really hard. Then we got other stuff in the background like tariff information. Well, if Trump gets what he wants and people start saying, "Hey, we're going to deal with this. We're going to make it work." Then you got the momentum of the market coming in, and I absolutely think that we can hit 90. Okay. But looking at the regular weekly ATR, we kind of get close to it, not quite there. All right. So a safer route, okay, I'm going to give you two different ideas here. A safer route would be do an 85 by 90, right? Because that puts us in the ATR. And then the lotto type, which I like going into earnings because you just never know. A lotto type would be taking my actual levels and looking at that. So let's price this stuff together. We're going to first look at the lotto type 90 to 95, and then we're going to look at the 75 by 70. Okay. So we are going to pull up an option chain right here, and let's pull in PLTR. And here's the next thing. Do you want to buy this week? Do you want to buy next week? I love that they're reporting tonight. So you have almost a week. All right. So we're going to come down here. This very important part, where we at in implied volatility. You know, 164% is quite a lot. That right off the bat, what you need to say to yourself is you're paying up 164% for the option itself. So you really needed to move in order to get paid. All right, whatever. Let's not get too deep into it. A trade is a trade. What you put on, at least you're using levels. You know how much you can lose. Let's not become scientists and try to like detail every little like gamma, you know, uh, delta, and all the other things that everybody looks at. I'm not saying they're not important, but I never use them. Right? I use my levels, and the result is either I make money or I don't. All right. So we come down here, and first of all, let's go over the basics of doing a debit spread. All right. So let's say that I want to go for 90 to 95. It is 5 wide. Everybody understands that. When I say 5 wide, I mean 90 to 95 is $5. Okay. So whatever we pay for this, let's say we pay 2, okay, then that means we're going to pay $2 and we have a 300 because 200 minus 500, we have a $300 reward and 200 is our risk. Let's just go ahead and look. I'm going to freeze the screen. So if I were to buy a 90, let's just say that we get in at 300 and I'm going to sell a 95, then you can see here it's $1.75. All right. So pretty close to what I was talking about. All right. So we offset this $3 minus 175. Okay. And that's going to be the cost of that option itself. And then over here on the other side, we were talking about put debits. We were talking about the 75 by 70. Now let's see how much this is going to be. 75, 254 by 70, $1.26. Okay. I did say 75 by 70, right? I just want to make sure. 75 by 70. Yep. 75 by 70. So the put side actually looks a little bit more interesting. So I would take 250 and I would minus right here, let's just say $1.30. And that is going to equal 120. This is only going to cost me $120, folks, for that protection, just in case we dump. Okay. So what does that mean? That means I can make, I'm only risking $120. 500 minus the 120, and that is my potential reward. Okay. So not bad at all. And that comes out to $380. Okay. 380. So what we know right now is if I were to buy this right now, this is going to cost me 120. Okay. 120 is the risk. 380 is the potential reward. Just like that. And then to the upside, let's go ahead and do this once more. 90. Sell the 95. And this looks like it's going to be about $1.20 as well. So this is the same thing. $1.20 over here. Wow, not bad, right? 120 risk, reward, potential. I don't want anybody new in here to think it's a guarantee. Potential reward equals 380. So we have our numbers. What is the total of the cost, everybody? What is the total of the cost for both sides of the trade? $240. So your question, is it worth it for you for $240 to make 380? That's got to be something that you have to answer for yourself. I'm showing you the process. Not all of them look like this. Sometimes you may get a reward that's like $800 and the risk is only 200 and something. All right. Now, how do you get more of a potential reward? You make it 10 wide, but you're going to end up paying just a little bit more. But let's just do it. Let's do a 90 by 100 on the upside, and let's just see. So if I buy a 90 and I sell the 100, I'm only going to pay about $70 more. Not bad. Not bad at all. Okay. And this right here could pay me 800. Uh-oh. So that means if we blow through 100 and this thing goes to the moon, right? You could make up to $800. Just saying. I don't want to do butterflies, Mark, on ever into earnings anymore, unless it's like super wide, man. It just for me, it's like why cap yourself on something that could have a 3 ATR, man? You know what I'm saying? Like there's just no reason to do it. So for me, all right, the 90 by 100 equals what I just say? $2. Potential 800. So what I could do, okay, what I could do here is now I could put this on. Now let's see down here. Let's do I'm going to do a couple different things here. How about an 80 by a 70? It's going to be 316. So we're going to get a little bit closer to the put side. So for $326, I could get 674. Okay. Even though that doesn't sound great, if we were to dump, I would actually pay for the entire trade of the 10 wides. Now let's do the same thing, but using these numbers, 75 by 65. Okay. The same thing is 293, guys. Or sorry, it's $2. All right. So basically for a 10 wide on both sides, okay, now it's going to look like this. 75 by 65 equals about 200 risk, potential, 800 reward. Okay. I like this one a little bit better. It's wider. It's only $400 and I can make 800. So I'm basically doubling. If all that needs to happen in order to get fully paid, either it needs to dump all the way or we need to go right through this by the end of Friday. Okay. Now, sometimes what will happen is Tuesday, you get one of these moves and they're not going to give you all of the potential reward because they know, the market makers know, we still have 4 days and anything can happen in 4 days. So even though you hit your benchmark, if you will, does not mean you will get the full $800 or close to 400 because you have 4 days. Yes, you could look really pretty on a Tuesday morning and by Friday be down here. Okay? Everybody understand that. None of this is a guarantee. But one thing that I personally like about this type of trading, okay, and this is how I teach traders to look at it differently, is if you came in here and say that you were a bull on PLTR, which there's many of them, you could come into the market not knowing a lot about options. Everybody, they just see dollar signs every time. I know this because when I first started trading, I was like, dude, all I want to do is make some money. Who cares about the downside, right? Well, I didn't realize the implied volatility and the price that I'm paying so much money for this type of stuff. So, the way that I can justify in my mind to take this trade is I'm allowed to play both sides using my strategy, meaning I'm identifying supply and demand. I'm not just making things up. I'm identifying levels that I show you every single day. It's not a guarantee, but now I can get into a trade for only $400. I am identifying two levels that could happen. And instead of being completely wrong and losing $565, I can be completely wrong and lose $400. Does everybody understand that? I would much rather spend $400 than $565 and only trade one side of the trade. And again, all while identifying supply and demand. So that is the type of trade for me that I would personally be taking on PLTR going into this week. I personally like the 10 wides because, yes, it would be nice to see some sort of breakout or break down into those levels. Now, again, as a disclaimer, right before the close here of this demonstration, we could go sideways and both of these could completely die. That means all your premium has come out of the trade. My go-to would be to buy back the short sides and hopefully one of the long sides ends up working out and making up for the 400 deficit that I just lost. Does everybody understand that? So basically what happens is when you sell back or buy back the short side, now you're long a put and you're long a call. And you're just looking for a bigger move to happen through Tuesday through Friday. Okay? The next thing that can happen, and this can sometimes be frustrating, is price drops down into a demand zone and everybody's like super excited. But what happens is that the demand zone works. So you're super excited here. You're counting your money. You're telling all your friends. And then by tomorrow morning, you wake up and it's right back to where it was. You get pissed off. You're like, oh, God. See, we are opening sideways. Well, at the end of the day, the moral of the story is you bought a debit spread for the for the put side in a demand zone. Technically speaking, your demand zone is supposed to work. So you want to see it bounce. Technically speaking, if we go up to the Fibonacci extensions, which you guys have seen my work before, like on our last Netflix trade, they work really well. So if it hits here, you could be super excited, telling all your friends how happy you are. And then by the time the morning opens, we actually open up flat again. This is frustrating because, again, you will lose the premium on both sides. So you're probably asking the question, okay, John, why not just sell the credit on both sides? So remember, I said debit spreads. Credit spreads are when you would sell this strike and buy back the strike here. So on your options chain, it would look something like this. Okay. That is the difference, how you can tell. Basically, what you're saying when you sell something like this, and then you have the credit on the outside like that, or the buy, you're looking for prices to stay between these levels and by the end of expiration, not close above them. Okay. Or you're just looking for the premium to get sucked out and for you to take advantage of that when the market opens. Okay. So the reason why I do not do that is because I've seen too many traders lose their ass because they're not expecting a big move. And then when it moves 3 ATR and goes against them, they're trying to figure out how to, as they would say, manage the trade. I'm not trying to manage a bunch of trades. It's just so much easier to buy zones. And if it works, it works. If it doesn't, it doesn't. And as I said before, guys, there's no reason not to trade earnings if you know what you're doing. It's just a trade. Believe it or not, in any market conditions, whether it's earnings, whether it's FOMC, whether it's tariffs, there are only two things that can happen to you when you take a trade. One, you can make money. Two, you can lose money. And if you understand both of those, then you shouldn't be afraid to execute a trade. Many people will tell you, well, the probabilities are better if I just wait after earnings. But I don't know about you. I've seen a lot of people trade something after earnings and also lose money. I've seen people trade the best executed plan of their life and still lose money. There are only two things that can happen. And when you truly understand that and use your system, you can't be mad at yourself. At least you executed what you put forward, you traded your plan, and that's the best thing that we can do.